Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
Call this a case of two scenarios. Here's the background. A member calls and requests to skip a payment on a loan balance. The loan term will simply extend by a month. Interest continues to be collected, and there's a fee, usually $15 to as much as $60 for setting up the skip payment. In scenario one, the customer service rep fields the call, talks with the member, checks to see if the member's request complies with the institution's guidelines, and also checks to see if there are issues that disqualify this member from skipping a payment. If all is a go, the rep takes the request to a manager, and then the request circulates up the ladder until it lands on the CEO's desk for final approval. That's for, say, a $200 loan skip. Yep, a $200 loan skip. Might be smaller. Scenario 2, an agentic AI bot talks with the member, swiftly computes the eligibility, and if it's a go, the request is approved. Of course, there can be, and often is, human oversight at the final decision moment. Which scenario do you like? Know that in many credit unions, scenario 1 prevails. Don't even attempt to calculate the cost of approving that skip, because often it costs more than the amount skipped. Many institutions lose money every time they approve a skip a pay request. Of course, enabling a skip a pay is a genuine credit union action. This is helping the members who really need it. Very few banks offer skip a pay because of the costs and the hassle. But more credit unions now are offering, and one reason why, in addition to the affordability issues confronting many households in America today, is that Maine-based fintech Constant AI has rolled out an agent that already is at work in dozens of credit unions, including the $8.5 billion Michigan State University Federal Credit Union, and institutions as small as $100 million in assets also deploy it. On the show is Constant AI CEO and founder Catherine York Powers, a native Mainer who, when Powers finally could, moved her company to her home state, and that's why Constant AI is based there. Listen up. You had some success in renewable energy and also set up an interesting sounding home finance, a home remodeling financing company. How do you jump from there to AI?
Yeah, it's a really interesting path. Like, I didn't jump into AI, even software, on purpose. So I was head of M&A for SunEdison and doing, global transactions for acquiring solar plants. And when the company had an exit, I had a chance to think about what I wanted to do next. And I really wanted to stay in that space. So I was focused on solar loans at the time. So moving from industrial commercial all the way down to consumer loans. And that's the company I started. It was Constant Energy Capital. And we were in 33 states and doing great. The problem was servicing those loans were really painful. We used a subservicer, and every time a member called or went into collections, they made more money. And so we figured we needed to automate this, just like we had on the front end when a customer got a loan. And that's how we ended up in the loan operations automation space. We built it for ourselves, so customers could just log into a portal and skip a payment, get a loan modification, change a due date, get their payoff statements, all those things. And then we realized we had, stumbled onto something that other financial institutions could use. So we sold Constant Energy Capital, the balance sheet where those loans were held, and then completely focused on this back office automation.
So what's your computer background?
I don't actually have a computer background, but when we built Constant Energy Capital, the focus was on allowing consumers to get a solar loan and then later roofing loans and home improvement loans because they all kind of go together, in 3 to 5 minutes. So fully automating that process for ourselves. So I had a chief technology officer that I built that alongside of. So it was, our vision together. And of course, him and the team implementing that. But once we started hitting a lot of friction on the loan servicing side, we decided to tackle that challenge together as well. So I don't have a programming background per se. I have worn the hat internally of chief product officer and learned along the way. And it's been an amazing ride.
Now, what steered you towards credit unions? And
Yeah.
I ask because for the majority of my life, I had no idea what a credit union was. If you offered me $100,000 to define credit union, you wouldn't have given me the money. You wouldn't have to worry about it. And then when I discovered them, I said, "Oh, wow, these are interesting."
Yeah, fair point. So when we decided to roll that customer self-service solution out into the marketplace, we actually started in auto and consumer finance because we knew some of those folks. They were in our ecosystem. Consumer finance was the sector that we were competing in. And one of our clients still to this day is Lithium Motors, which is the largest auto finance dealer group in the country. Consumer finance groups like Aqua Finance, they're still our customers. But what we realized was that credit unions really spent a lot of time on the member experience. And we knew this because Credit Union Loan Source, which does participations with credit unions for auto loans, became our client. And that's where we really first learned about the credit union space. And once we decided to focus on credit unions and their members, we haven't really looked back. We certainly have community banks as well, but in terms of our marketing spend and focus, we're highly, highly focused on the credit unions nationwide.
Now, my research tells me, and if the research isn't right, please say so, that skip a pay is really pretty uncommon among banks, but credit unions have more interest in it. Why don't banks have any interest in it?
Yeah. Well, credit unions are, this member-owned cooperatives. They don't answer to shareholders. So I think they can offer programs that build loyalty and goodwill rather than ones that maximize short-term fee income. So the cooperative principle of people helping people, I think, is what credit union leaders point to as the foundation for programs like Skip a Pay. And banks aren't prohibited from offering this, and some do. As I said, we have some community banks that actually do. But I think in general, the profit motive makes banks less inclined to defer revenue from loan payments. I think there's also, from a credit union perspective, there's a financial upside for credit unions that do make it viable because interest does continue to accrue on that unpaid balance during that skip period. And credit unions typically charge a processing fee anywhere from $15 to $60 per skip. So they are also enjoying some fee revenue. But frankly, when processing it by hand, some credit unions are still underwater, meaning the fee they charge doesn't cover the whole cost of offering the program because they're still processing applications that they deny and for which they don't charge a fee.
Yeah, I was thinking this could be totally wrong, but that psychologically, if say it's a credit card and you miss the payment, and this probably wouldn't happen on the first miss, but next month if you miss again, Chase is beginning to think, should we just like shut this account down? Should we just freeze this sucker?
Mm-hmm.
Okay. Now I'm the customer. I suddenly have no interest in this card or in the financial institution. Whereas if the credit union is working with me, I still might have some emotional attachment to seeking a resolution to this issue. Does that
Mm-hmm.
make any sense to you?
Yeah, I think that's the rationale in general behind the skip a pay program and frankly behind hardship deferments as well. But interestingly, you don't really see a lot of skip programs on credit cards and lines of credit because they're revolving, not installment. So there's no fixed payment to skip in the same way.
Well,
Um,
you have to pay an account minimum. And
yes.
if you have a big enough balance on your Visa card, that minimum can be pretty high. It's not $9. It could be, I don't know, $300 or something. I guess that'd be a pretty big balance you're carrying. But
Yeah, that's right. Well, that's what I was getting ready to say is the member already has the flexibility built in by only paying the minimum. So skipping doesn't have a clean definition on a revolving balance, so we don't see that as much. And same for lines of credit. And then, of course, real estate loans, just because they're governed by federal mortgage servicing regulations and have strict requirements around payment deferrals. But,
so
auto,
what,
consumer, RV, marine, personal, that's where you typically see skips on in installment loans.
and you said sometimes the institution declines to allow the member to skip a pay. What would be the reasons?
Yeah, typically it's offered to members that are current on their loan, but other reasons would be related to their account if they have an NSF or overdraft balance on their actual account, nothing to do with the loan itself. On the loan itself, maybe it's in bankruptcy or already being restructured. It could be in repossession status. The loan, it could be that the loan is not open long enough. Typically, you see credit unions offering this benefit after 6 months. It could be that the member has already hit the annual limit for number of skips. We often see 1 to 2 per year or 5 per life of loan. Those are usually the common reasons why they might decline them.
And the credit union gets to set those parameters.
Yeah, and there are some common threads through all credit unions, like that, number of skips, the length of time the loan has been on the books. And then there are some nuances, which is what maybe why others haven't tackled this in this way, is because there are a lot of nuances. And you do see some automation in digital banking. It's usually a bolted on solution in digital banking. But because the credit union rules are a little all over the place, it makes it harder to automate. It's frankly why you haven't seen a lot of this type of automation for all loan servicing, right? It's kind of I like to call it the dusty corner of lending because origination, more deposits, more members, those kinds of technologies typically get the investment when folks are sitting around the table during strategic planning, but loan operations, because there are few people automating these things and it's not as exciting or sexy as bringing in new members and deposits and loans.
What's the impact on the member's credit score if they skip a payment?
There isn't any, and that's the beauty of it.
That is wonderful. Why isn't there any?
They're current on their loan, and so it's typically offered as a member benefit or a loyalty option. So it's really allows members to press pause on a loan payment. Again, like I said, usually once or twice a year. The payment itself doesn't disappear. It moves to the end of the loan,
Right,
extending the
right.
term by 1 month. Interest is still accruing. So it's really seen as a benefit to help members with financial pressure, but it's not like a hardship accommodation.
Yes. The only way the credit score would be dinged is if the credit union reported the loan as with a missed payment, which they wouldn't do.
That's right. Yeah. And if a member goes, is not paying, or sorry, is not current, so they've gone past 30 days or 45 days or 60, that's when that reporting begins. This is typically a benefit that's offered to members that are current on their loan under 30 days past due. So no reporting would occur in any case.
Did you see any pickup in interest in your service during the government shutdown when many federal employees weren't getting a paycheck?
Yeah, interesting. So we have a product or have typically had a product that shows up in digital banking, so click-through screens, if you will. This is before our new voice agentic platform was rolled out, which is what I think precipitated this conversation. And those clients have used both skip-a-pay and hardship deferments because they're already automated during those government shutdowns. So we did see an increase, frankly, a spike in the use of that. And what we saw credit unions doing was offering these payment skips with no fee. So waiving the fee because they knew they weren't getting a paycheck in or that that was at risk. Many credit unions, again, for all the reasons we talked about earlier, offer this during those times. Just, also if there is a storm or something else happening, but they're still processing those by hand. And so there's usually a spike because many people are impacted at the same time. And those requests go into a fulfillment queue and then they get manually processed by hand, one by one by one. And it's not
Wow.
a simple, straightforward process, right? So I talked about some of those rules, why they might be denied. Let's say there are 7 to 10 rules. So a person processing this is checking every one of those rules against the core system, those fields to make sure that that person can qualify. Then they're taking that application, usually scanning it or putting it into the core. They're sending the decision back to the contact center to contact the member, and then they're processing that in the core, meaning they're updating the maturity date, updating the statements, taking the fee from the share account. And it's really laborious. That's why I said that many credit unions, even if they're charging a fee, are underwater because there are usually 2 people involved in that, the contact center who's communicating with the member, the person doing the processing, and it's all by hand. And a lot of credit unions are still doing it that way.
How many credit unions do you have as customers?
We have 31.
What's the size range?
From 100 million to 8.5 billion.
All right, that's quite a range.
It is right. Well, and some of the smaller ones are through reseller partners like Visify. I have a soft spot for the smaller credit unions, so we're trying to find a way to make sure that these automation offerings are available to small credit unions as well. And it really works when we can offer this through a reseller relationship. And frankly, offering it through our new platform where this automation behind the scenes or under the hood, if you will, can be extended out to voice AI and conversational chat is also helping to reduce the barriers for credit unions of a smaller size to access the solution.
Now, tell me about the agentic AI tool.
If you think about the underlying technology where the eligibility rules, the connections to the core, all the hard work that's being done that I mentioned when I talked about the processing, that doesn't change, right? It's we'll call that a state machine. It's locked down. We don't actually process any transactions using AI through that. And what we did, try to show you this visually, even though I know it's a podcast, think about our digital click-through screens as the head on top. We've made that state machine headless, and then we've layered an agentic AI shell on top so that we can deliver this by voice and by chat. And the power of this is not just that we can deliver this, right? Our first agent is called Nia, and Nia can deliver skip-a-pays, deferments, due date changes when a member calls in or in a member chat. But the powerful thing is that, and we'll use MSU FCU as an example, their chatbot is named Fran. You can talk to Fran as well if you call the credit union, and we're able to sit underneath that and power Fran to make sure Fran can extend her capabilities to loan servicing. And that's true for any partners that are providing this. So say like an Eltropy, Posh, TalkDesk, those kinds of companies that are providing solutions to credit unions and helping credit unions create their own personalities and bots, that we can sit under that and power that too. Credit unions do not have to consume Nia necessarily. They can keep with their own agents, and we would sit underneath powering those transactions. And that's really how our go-to-market, I think, it's going to prove out to be the fastest.
Well, I would think some consumers would be more comfortable about wanting a skip a pay talking with an AI bot than talking with a human being. Because I know I've talked to people who hate to go in and talk to a teller because the teller, they're afraid, is going to say, geez, you don't have much money in your account. The teller's not going to say that, I don't think. But it's in their imagination, they're running this script where they're being judged and people will say this and that. Whereas, the AI thing is probably pretty judgmental. The ones I use are. But you don't necessarily know that unless you ask the right question.
Yeah, fair point. I think anybody that is struggling financially, and maybe it's just holiday gifts are too expensive, summer vacations are too expensive, so it's a momentary thing, or maybe there is a long-term hardship, less hours at the job, or an actual layoff. Nobody wants to talk to a human being about that, right? And so what we found is that by automating that in any way and allowing members to self-serve in any channel, that we see a upwards of 25% uptake in those solutions or in adoption because one, they know it's available, two, they know they don't have to talk to a human being. And I think that's just human nature. And it's why one of the reasons why we decided to go to market with our AI solution, or sorry, agentic solution with SkipAPay. We think it's the perfect wedge because it's a popular member program, as we talked about, with a history of being difficult to fulfill, but one that really benefits members because they can have this private conversation and I think are more likely to talk to the credit union if they don't have to talk to a human, if you will.
Now, are you seeing any increased interest in the current inflationary spiral, particularly at the gas pump? I mean, I looked at an interview today with a long haul trucker who said it had been costing him $600 to do a fill up. Now it's 1,000. That's a big difference.
Yeah.
I mean, truckers are not poorly paid, but they're not extremely well paid. And suddenly you're shelling out $400 more for a fill up. I mean, this is serious money.
Yeah, and in fact, I was just booking a flight this morning, and I couldn't believe the cost of flights right now and on a short hop to a nearby city. Yeah, I mean, certainly this market is crazy. A lot of people are being impacted financially, and they're just over the past year, not just recently, but over the past year, I think credit unions, all of our clients, frankly, have seen an increase in an uptick in requests for payment skips and even deferments. And that tracks, right? The increase in delinquency, people rolling from one bucket to the other, 30, 60, 90 days, increase in charge-offs. That's leveling off a little bit right now. But for sure, there has been an increase in these programs that can help people through these hard times.
So you're talking with a credit union. They say, okay, we want to do this. Take me through the steps that follow that. And what happens next? And does the credit union have to do? I'm always interested in what the credit union burden is in implementing new financial technology.
Yeah, so there are three real steps. One is we typically will hand the credit union what we call an out of the box process, right? Which has the rules that most credit unions use to drive their eligibility for this. And that saves time from send me your policies and us figuring out how to fit it into how we operate. We just send them that. And what we've seen is credit unions reviewing their own rules and saying, hey, well, this makes a lot more sense. This is true and tried across credit unions. That process is usually done, within the first 30 days. Kickoff, review that. And that's where the hard work is from the credit union's perspective. And of course, doing the user acceptance testing at the end. We take most everything else. So once we have access to the core system and we're already integrated with Keystone, Scimitar, DNA, Silver Lake, et cetera. So we already know those cores very, very well. So we're doing the connections to the core system fields that are impacted. So for example, one of the rules is, cannot be 30 days past due. We're tying the system to that field in their core system so we can check that they're not actually 30 days past due. And that work it's really 90-10. That's on us. We just need access to the credentials to be able to do that. And then on the voice side, it really depends on whether we're using their provider. So again, if it's, an ultra posh talk desk, then we're doing the work with them to make sure that they can access our partner API. And so when they're driving the conversation around the skip a pay, we are feeding them the inputs. So in other words, if you call in and you talk to Fran at MSU FCU, for example, and you say, I want to skip a payment, that's when our partner API triggers. So again, no work there, or very little work, I should say, there from the credit union's perspective. They definitely want to know, if the voice or chat is having the conversation in the way they would expect it to be had to match the style and tone of the credit union. But that all happens in UAT. So quickly summing that up, the credit union is responsible for working with us to confirm their eligibility rules, giving us access to the core system so that we can tie everything to the right fields, and then usually working with their partner, if they already have a partner, that's providing the voice, and then the credit union is doing the user acceptance testing. We normally can stand somebody up in 60 to 90 days.
That's pretty good. What's the fee structure for credit unions?
So there's typically an implementation fee, and we bill on autonomous transactions. So if the member is approved or denied, there's a fee for that. So the way we do this is it's tiered, and based on what we expect the credit union's volume to be, we'll put them in those tiers, and there's a flat fee with a certain number of autonomous transactions included in it. We like that term because if a member calls and abandons, or hears the terms and conditions and cancels, or they get interrupted because the baby's crying and they hang up, we don't charge for those. We simply charge for anyone that's been approved or denied, which matches what they would have done if the credit union was processing it by hand.
Now, what's a typical number of skip a pays in a month for one of your credit union clients of some size? Pick a number. I don't know, 500 million, a billion. So how many skip a pays are they doing in a month?
I'll do it by percentage. We can quickly do the math, but like if let's say it's a $1 billion credit union, usually we're seeing, this is actually across the board, we're seeing anywhere from 4 to 6% of the eligible loans seeking payment skipped. And right now, that's been the average over the past few years. Right now, it's really pushing up in that 6%, in some cases higher. So as I said, we're seeing that increased based on where the market is today. But that's usually the percentage, and that's across all credit union sizes.
So 6+% of the loans, that's significant. It's not overwhelming, but it's significant.
Sure, yeah, 100%, especially if you're processing it by hand, and being able to automate that really does free up those loan servicing experts to help with more complex problems with people who are actually experiencing financial stress and maybe need a loan restructure or something more complex that folks are not automating. That's where the time of a loan servicing person should go. Even the contact center, that's where their time should go, helping those members, not processing something over and over and over all day long that a machine can do.
Is there an option where the member can say, hey, no, I don't want to talk with this bot. I want to talk with a real person?
Yes, 100%. So we allow for, this is true for our voice agent, Nia, and also true for any of those companies that offer voice and or chat, that if they prefer, if they get stuck, or if they just prefer to talk to a human, there's a really simple handoff. They request it, they're handed off.
And generally, I prefer to talk with a machine.
Yeah.
You can call me weird, but that's all right. The machine wouldn't call me weird, so that's why I talk with the machine.
Not unless you asked it to, right?
Then it would be more than happy to call me weird. Wow,
exactly.
really eccentric and weird. Yeah, that's lovely. You're so great. Thank you.
Exactly. Whatever you want to hear, it will let you hear it. Well, but you said this right. I think you captured this earlier when you said that when it comes to assistance, where people are struggling financially, they don't want to talk to people. I mean, that's just human nature. So I think that's an even more powerful reason why skip a pay and deferments should be automated and should be offered to members, allowing them to self-serve and not have to talk to a human being, especially in a branch. Like, do you really want to walk into a branch and sit down with somebody face to face and have that conversation? And there are some credit unions, because of the complexity to process this, they do require you to talk to a human being.
To go back to kind of your business model, it's difficult for me to see that it's not costing the institution a lot of money to have a human being process this thing. I mean, it's money that doesn't have to be spent, I don't think. So I would really not want my members coming in and talking to someone in the branch about skip a pay. I think, just do it online, man. It's,
Yeah. Exactly. Yeah, I mean, the average cost, this is again across all of our credit unions, but the average cost is anywhere between $13 and $20 to process a skip. And it really depends on the complexity of the credit union's rules. And, we do have some credit unions that when they came in fact, I spoke with one yesterday, that their original process was a form gets sent in. The chief lending officer is involved in the decision with the processor, and then they take it to the CEO
oh my
to get
heavens.
to get sign off. So like that, at the lower $13 processing would normally cover the call center interaction with the member as well as the processor in that situation. But when you add on the hourly cost of the chief lending officer and the CEO, you can see how that could
But
rack
that's
up
just
quickly.
crazy
It
time.
is. It
It's
is.
for a lousy $100 skip. If you have to get senior executives in the credit union involved, you're doing
Exactly.
something seriously wrong.
Yeah.
It's
And I think
you,
that's why folks are, happy to have us help, because they know that that's not scalable, and you want to market this, right? This is a loyalty opportunity for members. So being able to say, we have this fantastic offering. If you hit a bump in your financial road, you have this option to skip a payment for this nominal fee. You want to market that. But when you have executives involved in the process, you can't market it because it's not scalable. So I think people are thinking differently about this, especially with the increased requests for financial assistance.
do you help the credit unions with how to market it? And I ask because it's pretty common. A credit union CEO, I'll ask them about some technology they're using. They'll say, "Well, we've used it, but we're going to give it up because it doesn't work." And much of the time, not all of the time, I talk to them, and the problem is that they did a terrible job marketing it to members. Members barely know it exists.
Mm-hmm.
So it's not the fault of the technology, which, by the way, a lot of other institutions says works great. It's your own fault. But, but I've over time come to believe that the fintech has to help provide some marketing material because a lot of particularly smaller credit unions are just out to sea on that.
Yeah, we absolutely do. It benefits both of us, right? We really want to see high adoption as quickly as possible. We want to make sure that the credit union sees the return on investment and also the increase in interaction with their system, whether it was in digital banking or their voice system. The members are actually engaging with them. So we have a full marketing plan that we roll out usually a month before they go live or a few weeks before they go live, suggesting how they can do this. And it includes everything from, if you have an IVR and you want the IVR to point to Nia, for example, our skip a pay agent, you can say, hey, press one for this, two for that, and three if you want to skip a loan payment, all the way through, you know, making sure the statements show that there is a new skip a pay program, marketing it in digital banking. So we offer all of those different options, obviously the socials and so forth, but we are very heavily involved in that.
I think I got what I wanted from you. Anything you want to say that I wasn't smart enough to prod you into saying?
No, I think we captured all of it. I will maybe just close by saying, I mentioned at the front end that Skip a Pay was our wedge product. All of the things that we automate today or have been doing for the past few years in digital banking, So changing your due date, full on loan modifications, changing your pay frequency, like from 1 month, paying your loan payment once a month versus 2 times a month, if that's offered by the credit union. We do all of that. We just rolled out Skip a Pay in the voice channel because of all the reasons that we've discussed here today. So we're already starting to upskill Nia with deferments and due date changes. So a member shouldn't have to figure out which feature a credit union has that will solve their problem. They should just be able to call and say, I can't make my loan payment. And we should be able to serve up the thing that actually helps cure the situation. So if a member called and said that, rather than saying or them knowing they have to access the Skip a Pay program, if they just say, I can't make my loan payment, and let's say they've already gotten their 2 payment skips for the year, if a credit union offered it, we could say, well, hey, would you like to change your due date? That might give them 15 days of breathing room, for example. Or if we saw in that moment, because we're connected to the core, that they are 30 days past due, we wouldn't even offer any of those things. We would go directly to a deferment, which is what credit unions typically offer when someone is past due. So again, the brilliance of agentic AI is not just conversational, right? It's actually helping to solve the problems based on the intent and what the member is telling you.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey. Again, that's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.